Hello, how are you all? Welcome back to the YouTube channel Dr. Labib Academy. I'm Dr. Labib speaking on behalf of the Dr. Labib Academy. Welcome you all. Today we are going to have a session on financial reporting, focusing on ratio analysis, financial statement analysis. It's a 20-mark question where you are going to have the calculation part and the comments or assessment part, or you have to write the report. Usually they will give less marks. Proportionately weightage will be less for calculations. Writing part they will give more weightage of marks as such. I kindly request you all to see the video till the end, and in the end just to make the purpose is to reach the people, students, as much as possible. Like it, share it, and subscribe it. The moment you subscribe in the channel, I will post the videos, automatically notification will come to you. It will help you a lot. Okay, so I kindly request you to like it, share it, and subscribe. Coming back to the concept of financial reporting. Now, in the financial reporting, we are going to do one question related to financial statement analysis. In our words, we can say it is a ratio analysis. Okay? What they are mentioning, see the things. What first and foremost, keep it in mind. This is the most important thing we should know. This is the tricks of trade, I can say like that. You have to know what is the question they are asking. Any subject, any paper, okay, any paper in ACCA, first make sure that in the reading time you have to focus on this only. Okay, they are asking us what? They are asking you to calculate the relevant ratios relevant to those given above for Astral. Means they have given the ratios for Astral. We are not. They have given two companies. Which are the two companies? They have given the two companies, Astral and Breakout. Fine. They have given two companies, Astral and Breakout. They have given the ratios for Astral. We have to calculate the ratios for Breakout. This is the most requirement. What is required is very important. Right? This is the tricks of trade. I can say this is the way you have to work very smartly. Requirement means you have to calculate the ratios. How many marks are there? You have to calculate, and marks will be 8 marks. And next part, what they say, I have attached the same answer. Okay, I have not given anything. I have not done anything. Whatever is there, I have just taken that one. Assess the relevant performance and financial position of Astral and Breakout. They are talking about assessing. Assessing is nothing but comparison. Is it assessment of the two companies to inform the directors of ACCA. ACCA is what? ACCA is, I think we will, is it? ACCA is the one company which is going to assess the performance of Astral and Breakout. Fine. First means you have to, how many marks are there? 12 marks are there. See the thing. For calculation, they gave you 8 marks. For assessing and writing the thing, they gave 12 marks. Total marks is going to be 25. Now, okay. Now, what they say, Hassel Company is a large public limited company that would like to acquire 100% of a suitable company. They want to acquire another company. Okay, fine. It is obtained the following draft financial statements of two different companies, Astral and Breakout. They operate in the same industry, which is clothing manufacturing business. Within the fashion sector, both companies compete in the younger, they target younger age people. They have the high turnover and they give discount fashion markets. Right? This is the basic background. Okay, this makes things. This is the basic background. Whenever you are doing this, whenever we are going to write the comments, assessments, we have to give some reference to the industry also. It really adds value to our answer. They gave for Astral, they gave for breakout. Fine. Now, in the same way, they are talking about the financial position of Astral and breakout. See, ratio analysis is very simple one. Ratio analysis, you have to understand, you have to memorize, very simple. Memorize the formulas, and you have to use those formulas as applicable to the data given. It makes sense, easy, and we can score a good marks in that. They gave you the things. They're talking about the two different things. Both the companies operate in similar premises. Additional data is they have they have owned the plant. Is there? Now you see the things. What happened? There is a lease. Is it? It will have impact. Okay, it will have impact on the capital. Is it? Lease is there. How much is the lease? This lease is only applicable for breakout. Lease is applicable. There are no disposals of plant. The interest rate implicit within the breakout is 7.5% per annum. For lease, how much they are paying? 7.5%. For purpose of calculating IRS and all lease liabilities are treated as a long-term interest-bearing borrowings. Fine, long-term interest-bearing borrowings. The following ratios has been calculated for Astral. Return on capital employed, all those things. Okay, calculate the relevant ratios. What are the first thing is return on capital employed. See, very simple is that they will test you. They will test in such a way that even we have to be very careful for this. What is the formula for return on capital employed? Return on capital employed is profit before interest and tax divided by capital employed. Fine. Now, what is the profit before interest and tax? That profit before interest and tax. Gross profit is how much? Gross profit is 2,500 minus operating expenses are how much? Operating expenses are 500. Fine. Next, see the things. This is very, very important, very crucial, very crucial. Most of us will ignore this. Immediately, what happens? This is a short term. Overdraft is a short term. Overdraft is not a long term. Fine. Overdraft is not a long term. It's a current liability. Now, for this, we have to deduct the interest on overdraft. Is that interest on overdraft? 10. Fine. We should not take that into consideration. How much is there? 1990. 2,500 minus 500 minus 500 minus 10. 1990. Fine. See, this is very, very crucial. People will straight away take interest is how much? Interest will say that 300 plus 10 plus 290. They take interest as 600. No, we should not take. We have to take interest is how much? Interest is only for return on capital employed. Okay, only for return on capital employed. This is the we have to take into consideration. Whereas, where we are going to use interest, we are using interest in the interest coverage ratio. Fine. There it will change. Now, how much is there? We have this is the profit before interest and tax. Okay, this is profit before interest and tax. 9. What is the capital employed? We have to calculate capital employed is how much? Capital employed is total equity. Total equity is how much? 2,800. Total equity is how much? 2,800. Lease is how much? They say that lease has to be taken into consideration. 3,200. 10% loan is there. 10% loan is there. 3,000. People think that ratio analysis is easy, but they will somewhere they will test our understanding how we are working on that. Lease liability is there. Lease liability is how much? Lease liability is going to be 500. If you make a total of this 2,800, 3,000, 6,000, 9,000, 9,500. This is capital employed. What is the formula for this? 1990 divided by 9,500 into 100. Return, when we are talking about the return, divided by 9500. It comes to how much? It comes to 20.94. 20.94. Put one dash here. Fine, put one dash here. Next, that 20.94. 20.94. Next, what we have to do? We have to take into consideration the return, pre-tax return on equity. Okay, pre-tax return on equity. Pre-tax return on equity. What is the formula? Profit before taxes, pre-tax. Okay, total equity. Profit before taxes is how much? Profit before taxes is 1000. This is profit before tax. Is it? Profit before tax is how much? 1400 divided by total equity we have done. How much? 2800. It comes to how much? It comes to 50%. Put one dash here. Okay. How much is it? It comes to how much? It comes to 50%. Next, what is the net assets pre-tax? Okay, net assets, total assets less current, net assets turnover. Is it? Net assets turnover, total assets less current liabilities. Okay, net assets turnover. Is it? Net assets turnover. Is it? Total assets minus current liabilities. Total assets minus current liabilities. Total assets are how much? What is the formula? Formula is sales divided by total assets minus current liabilities. Is that? Sales is how much? 20,500. Is it right? This is the sales. This is the sales. 20,500 divided by total assets are how much? 14,800 minus current liabilities are 5,700. Right? Current liabilities are how much? 5,700. 5,700. Total assets are how much? Total assets are 14,800. It comes to how much? It comes to 20,500. 20,500 divided by 14,800 minus 5,700. 2,500 divided by 14,800 minus 5,700. It comes to how much? 2.25 times. 2.25. Okay, 2.525. They will be small plus or minus will be there. Don't worry about those things. Yeah, they will not. Yeah, 2.25. Okay, 2.25. Next, what is the gross profit margin? Operating. How much is the gross profit margin? Gross profit margin is how much? Gross profit divided by sales times 100. Okay. How much is the gross profit? Gross profit is 2,500. This is the gross profit, 2,500. Sales is how much? 20,500 times 100. Right? It comes to how much? 2,500 divided by 25. It comes to 12.2%. Fine. Next, what is the your operating profit margin? Operating profit margin. Operating profit margin is, we have to take the say operating profit divided by sales into 100. Okay? Operating profit divided by sales times 100. Here operating profit is how much? Operating profit is gross profit. Gross profit is how much? Gross profit minus operating expenses. Gross profit minus operating expenses. Gross profit is 2500 minus 300. 2500 minus 500. Is it? 2500 minus 500. Operating profit is how much? 2000. 2000 divided by 2500 times 100. Is it? 2500. It comes to how much? 9.8%. Is it? 9.8%. We'll take all the things we have done. Next, current ratio is there. Is it? These are simple ones. Is it? Current ratio. Current ratio is current assets divided by current liabilities. Right? Current ratio. Current assets are how much? Current assets are 7,300. We have done current liabilities 5,700. Is it? 5,700. It is a proportion. Is it? It is 1.3:1. 1.3:1. Next, what is there? We are talking about the inventory. Inventory, close inventory holding period. Inventory holding period, is it? Closing inventory only. There is only one inventory. Is it? There is only one inventory divided by what is there? It is cost of sales. Okay, cost of sales is how much? 18,000. Is it? Cost of sales is how much? Cost of sales is 18,000. How much is the inventory? Inventory is 3,600 divided by 18,000. Is it? 3,000. This is in the period. The moment we say period, it will be in the form of days. Times 365. Is that times 365? It comes to how many days? 73 days. They will ask you in the MCQ also this type of question. If you see the mock, the practice question, they have done something like that only. Okay, they have done like this. Next, trade receivables. Trade receivables. Collection period. Is it? Collection period. What is the formula for that? Trade receivables divided by sales. Is that? Trade receivables divided by sales into 365. How much is the trade receivables are there? Trade receivables are 3,700. See the things. Here it is there. How much is there? 3,700. And how much is the sales? 2,500. Is it? 3,700 divided by 2,500 into 365. Into 3, how much was it come? 3,700 divided by 25 into 365. It comes to how much? It comes to 66 days. Is it? It comes to how much? 66 days. Put one line here. Is it? Put one line here. We will do the things here. Next, trade payables. Okay, trade payables. Payment period. Okay, trade payables, payment. Period means automatically you have to take into days. What is the payables? Payables divided by cost of sales times 365. Fine. Payables divided by cost of sales into how much is the payables? Payables is there somewhere down. 3,800. Is it? 3,800 divided by cost of sales is how much? Cost of sales is 18,000 into 365. 3,800 divided by it comes to how much? 77 days. Okay, fine. Gearing ratio. Gearing ratio. See, they have given here. I am going with the same thing. Gearing ratio, interest coverage ratio, and dividend cover ratio. I will write here how much we have done. Gross profit is how much? Gross profit. How much we have calculated was 12.2. Right? Gross profit is how much? 12.2. 12.2%. Gross profit is good. What is the operating profit margin? Operating profit margin, how much we have calculated? Operating profit 9.8%. Is that operating profit margin how much? 9.8%. How much is the current ratio? How much is the current ratio? 1.3:1. 1.3:1. How much is the inventory? Inventory is how much? 73 days. Inventory is 73 days. And how much is the trade receivables? Trade receivables is 66 days. Right? And how much is the payables? Payables is 77 days. Payables is 77 days. It will help us in the interpretation when you are going to compare two different companies. Then we will have a very comprehensive. Trade payables is gearing is a C note 3. What is the note 3? They are talking about 7 point. All lease liabilities are treated as long term. This is very important. This all lease liabilities are treated as a long term interest bearing borrowings. Fine. This makes the difference as such. Is it? Now gearing ratio. What is the gearing ratio? Gearing ratio. How much is the? See, we'll take this into consideration. Is it? You have that lease 3,200. Is it right? You have that loan 3,000. Is it right? And you have the loan, and you have something here also 500. Is it? This is the lease liability. How much is there? This is the 500. Means how much is there? I will write for your understanding. Okay, I will write for your understanding. Non-current liabilities are how much? Non-current liabilities is 7% loan. Is it 7% loan? It comes to 3,000. 7%, 10%. Sorry, it is not 10%. 10% loan is how much? 3,000. Okay, 10% loan is 3 months. Is it? Lease liability is how much? Lease liability is 3,200. In the current liabilities also they are given lease. How much? 500. If you put all the things into consideration, it is 6,700. Gearing ratio is what? Gearing ratio is long-term liabilities divided by long-term liabilities plus the total equity. Is it? How much is the long-term liabilities? 6,700. 6,700 divided by total equity plus liabilities. How much? 9,500. It comes to how much? 0.71 or 71%. Is it? Or 71. How much is there? See the things. Here it is how much? 71%. Next, interest coverage ratio. Is it? Next, what is there? Interest coverage ratio. Is it? Interest coverage ratio. Interest coverage is in terms of times. Okay, in terms of times. Interest expenses. Interest expenses. Is it? Interest. 1 minute. Is it? interest coverage ratio is profit before interest and tax. Is it profit before interest and tax divided by interest expenses? Is it divided by interest expenses? Profit before interest and tax we have done 2000. Is it gross profit minus operating expenses? Is it profit before interest and tax? Interest expenses we have to take full 300 plus 10 plus 290. Okay, we have to take all expenses. It comes to how much? 600. 2000 divided by 600. 2000 divided by 3, it comes to 3.3 times. It comes to how much? 3.3 times. Next, last, dividend cover ratio. Is it? Dividend cover ratio. What is the formula for dividend cover ratio? Dividend cover ratio is profit for the year divided by dividends paid. Is it? What is it? Here only I will write dividend cover ratio. Dividend cover ratio. Is it? Profit for the year. Profit for the year divided by dividends. The profit for the year is 1000. Dividends are how much? 700. It comes to 1.4 times. It comes to how much? 1.4 times. Understand what? It is how much? 1.4 times. Now we have all the things into consideration. Is that we have calculated all. See, examination point of view, keep it in mind. Out of how many ratios are they calculated? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Out of these 12, 6 will be there. Almost. Is that we can assume. There is no guarantee, but 6 out of these 6 will be there. Okay, 6 will be there. Plus they will add. They will do. Now we have calculated all the ratios. Fine. Yeah. Hopefully it makes very simple. It doesn't make that much time. Okay, because we are doing with explanation, it will take little bit more time. We have calculated. Now what they are asking us? They are asking us to make an assessment. Fine. To make an assessment. I have not written this. Whatever is given in the resource material, I have taken the same thing. I have pasted here. Okay. What they say, they are talking about the breakout company profitability. At first sight, it appears that Astral company which is much greater return on its investment if it requires breakout company. The breakout is how much? Breakout is how much? If you take breakout, is that how much is that? 20.94. Okay, 20.94. How much is the breakout? 20.94. You right? See, you just mentioned unless at 20.94. What is that? This is return on capital employed. Is it? Rather than Astral, a closer analysis of figures suggests it may not be the case. Astral is how much? If you take the Astral return on capital employed is only 14.8%. Yeah, return on capital employed is 14. See, we see that yes, this is return on capital employed. Now if you compare it, then we'll say that yes, breakout return on capital employed is more. Astral capital employed. Breakout has a return of capital employed 40% higher than Astral, and return on equity more than double. How much is the return on equity of breakout? 50%. Is it? 50% and 9.1. What is the 50%? And what is the Astral is how much? Astral is only 19.1%. Definitely, see the thing. See that they say that yes. However, the difference is due to what? The low level of equity in breakout, then the superiority of profit. Now, what happens if you take into consideration is that how much is the equity? You compare it. Is right? You have to compare it when we are doing the thing. See the thing. Yeah. How much is this? See the total equity. Here equity is less, 2,800 only. How much is the equity? 2,800. Here the equity is how much? Equity is more. Return on is a return on equity. Because return on equity is higher, because the return on equity is higher in Astral, the return on equity, the total equity is higher in Astral, the return on equity is lesser. This is what we have to understand. Is it? The total equity is higher in Astral. Fine. And total how much is it? It is 5,500. Whereas total equity in breakout is how much? Total equity in breakout is how much? Total equity is, it is only 2,800. Fine. Now, what is the how we have done return on equity? Profit before taxes. Is it? Profit before taxes. Now you just compare profit before taxes also. If you take into consideration profit before taxes, see the profits, gross profit is less. Gross profit before tax. See the thing. Profit before tax is less here. Is that? Profit before tax is less. Profit before tax is less. Equity is more. Is it right? Profit before tax is less. Equity is more. Profit before tax is less, whereas equity is high. Here the profit equity is less. Profit before tax is how much? 1,400. Because of this, definitely we have to mention that. Okay, this must see this F7 paper. They will be very specific. Is it? Then the superiority of the breakout equity is 2.8. Is only half of the Astral is 5.5. That's why we are this reduce the denominator of return on capital employed and return on equity. Fine. It will have impact. In addition, Astral revalued the assets, evidenced by the existence of surplus. We have revaluation surplus. Is that? We have revaluation surplus. Where it will be there? It will be somewhere in the equity in the equity. See the thing. Here they have the revaluation surplus. When they have revaluation surplus, they have revalued the assets. Okay, they have revalued the assets. Because of that, that is also one of the reasons of impact. Increase in if assets are increased in asset value, will have definitely what will happen? It will have impact on return on equity, but do not contribute to earnings. See, as the value of assets are increasing, is it? But proportionately the earnings should also increase. Hence, return on capital measure may appear worse for us. We think that yes, return on capital is how much? Return on capital is only 14.8%. Here the return on capital is how much? 20.94%. Fine. 20.94%. What it say? A closer is a return on capital. Words for Astral. A closer look at the profits of both the companies shows that operating profit is how much? 10.5 and 9.75. There is not that much difference is there. Is it 10.5? How much we have calculated? 10.5 and 9.8%. How much they say? 9.75 or 9.8. That's fine. Is it 10.8 and 9. Fine. Okay, it's not that much huge difference. Fine. If there is a huge difference, then the net assets turnover is how much? Breakout is 2-3. Suggests that the running of more efficient. See what happens? You have to use assets as many as the higher the net assets turnover ratio, it means the higher the efficiency. You have to use the assets. Is it? You have to use the assets as much. Breakout has certainly achieved a much greater turnover than Astral. How much is the for Astral? How much is the net assets turnover ratio? 1.2 and 2.25 times. Is that? It is how much for the Astral? Is how much for the Astral is 1.2 times. Is that 1.2 times? 1.2 times for Astral. This could be due to what? Definitely, this due to the revaluation. Now you can understand how much the revaluation will have impact on the ratios which we have calculated. The problem is on a much higher turnover, net profit is not much higher than Astral. Now again, what we have said, we will see the thing when stage by stage you have to work it out slowly. Is that here profit is how much? Profit, net profit, profit for the year is 900. Here how much it is? 1000. Right? This makes the means now you can understand. We have to be little bit careful. 12 marks are there. 12 marks makes the real difference. Yeah, 12 marks will make the real difference. How much is the net assets are there? In here, how much we have calculated net assets? Net assets are 14,800 minus 5,700. 14,800 minus 5,700. Net assets for breakout is how much? I will write here. Is that net assets? Net assets for breakout is how much? Net assets for breakout is how much? 9,100. But keep it in mind, breakout has taken on lease. Okay, breakout has taken on lease also. They have taken some assets on lease. Is it? Some assets on lease also. Fine. Net assets. While breakout factory must be rented, partly accounting for higher level of expenses. Operating expenses includes rent. Okay, operating expenses. You see, these are all assumptions. That we can assume these are operating expenses. Here operating expenses are how much? 240. Here the operating expenses are more. When they say that, see the thing. When they say that they are, that is the reason they have mentioned here very clearly. What they have mentioned here, they say that they are a younger, high turnover and discount markets. And apart from that, they said that they operate in the same industry, is right, and in the same premises also, is it? Somewhere we have covered here. They have the similar premises also. Fine. Now, when you have all the things, definitely if operating expenses are higher than the other one, there should be some reason to discuss. Yeah, why? Because the operating expenses are increasing. Definitely it will have impact on profit before interest and taxes. Yeah, it will have impact on profit before interest and taxes. It will have impact on profit before taxes. It will have repercussions. Fine. It will have repercussions as such. Fine. This is where we are talking about. The Astral factory is carried at the current. They have revalued. Is it? When they have revalued, they have carried at the current value. Whereas breakout will have in terms of another company, it is not exist. Okay. This we are going to do with respect to what? With respect to the profitability. The second part, gearing. Breakout has a double the gearing. How much is the gearing ratio for the breakout? Breakout is how much? 71% and 35.3. It is really it is breakout has a double. It is 71%. It is 31.3%. Just I want to make sure that 35.3. Sorry. It is how much? It is 35.3. Okay. Due to lease obligations at 7.5 breakout is paying less. They are paying the interest on lease. Is it? 10% is on the loan. Is it right? 10% is the loan. See, these things have to be very. We have to be little bit analytical. Is it? How much is they are talking in terms of 10% is on the loan. Fine. Then they are taking loan on at the rate of 10%, and they have the lease at 7.5%. They have the lease at 7.5%. Go through this video again and again. Make it a point. Understand the concepts. Understand the process and make it sure that how it is going to be work it out. Yeah, by paying less on the lease than on the loan notes. On the lease they pay 7.5 and on the loan they pay 10%. But it still amount is doubling the interest payments. Yeah, interest coverage is how much? 3.4 times compared to 6 times in Astral. Yeah, compared to how much we have calculated interest coverage ratio? 3.3 times. And then what is the formula for interest coverage ratio? That's what I say. Profit before interest and tax. Is it? Profit before interest and tax. How much will come? See here also profit before interest and tax is lesser in Astral. 1,500 minus 240. Is it? Whereas here the profit before interest and taxes in breakout is higher. These are all the things. The moment we investigate, we go in detail, these things will be higher. In a bad year, breakout could have trouble servicing its debts and have nothing to pay to the ship. Definitely, if things are good, fine. But if things will not, fine. What they have to pay? A higher amount of, they have to pay the loan as well as the interest payments on the lease. The breakout has chosen to operate at a higher gearing. Definitely, rather see what will happen the moment the debt will increase. Is it? The most important thing is what? The financial risk will increase. This is the common rule which we should make it a point. Whenever the debt will increase, the financial risk will increase. Yeah? With leverage, what will happen? With gearing, the financial risk will. That's what they want to say. That if they are chosen to operate at a higher gearing ratio from the shares is also the potential returns on the share. Definitely, what will happen if the higher the gearing, the lesser will be the higher the interest expenses, lesser will be the tax, and the advantage will be given to whom? The advantage will be given to the shareholder. This is what we have going to have the understanding. Now, liquidity, what happens? See the thing. How much is the liquidity current ratio? Yeah, go through it. Current ratio. How much we have calculated? 1.22 is to 1, 1.3 is to 1. Is it? It is here. It is how much? 1.2 is to 1, 1.3 is to 1. Yeah, I will write here 1.2 is to 1, 1.3 is to 1. They have a broadly similar current ratio but showing slighter higher level of risk in case of breakout. Why breakout is also having the overdraft? Yeah, they have the overdraft. If you see the current liabilities, how much breakout is having a current liabilities of how much? They have the current liabilities of 1.2. Okay, just we should not go. We should not go with just 1.2. Here there is no overdraft. Is it right? Here there is no overdraft. Here there is a overdraft. We think that yes, 1.2 is to 1, 1.3. We will immediately say that yes, breakout is having a higher current ratio compared to Astral. No, Astral doesn't have any overdraft, whereas breakout is having overdraft. If they have the overdraft, it means that, see the thing. Now you will say it is not a simple ratio analysis. They have the higher level of risk in case of breakout. What is the reason? They are having the overdraft. Fine. Now, Astral is pursuing receivables slightly less aggressively than breakout. How much is the receivables? Receivables is 73 days and 66 days. Fine. That's fine. That Astral is less aggressive. Where is that in receivable? The Astral is how much? 66 days. Here how many days? 76 days. Breakout. Means as this does not appear due to shortage of cash, Astral is able to negotiate more favorable terms than Breakout. Okay. See, this is how it has to be worked it out. How the number of days, if receivables, see receivables correction period has to be lesser, is it? That should not be on a higher side as such. Got my point? See what we have done. We have talking about they have mentioned very simple. Is it? I have not done anything. Just I have taken that things that have been given to there. Just I have taken that and I am explaining how it is going to be there. We have to be very specific. Don't write simple things that this much in this is Astral is this much, Breakout is this much. We have to give that. Don't write any definitions. Don't write any comparative figures. You should be very specific. What is the reasons behind? You have to touch the values, calculated values, but you have to be very focused on the insights of the reasons. Fine. Next, we are talking about Breakout has a higher turnover than Astral. Turnover in terms of what? In terms of inventory. Fine. In terms of inventory, what turnover we have calculated? We have calculated return on capital employed. We have calculated return on capital employed. Fine. Trade interest coverage ratio, dividend, closing inventory. Yeah. Net assets, see 1.2 and 2.25. Is it 1.2 and 2.25? Higher turnover is how much? Here it is going to be Breakout is 2.25 times, whereas it is how much? 1.2 times. This makes an attractive position for the shareholders' view. However, the turnover will were to fall, there would be a little left to distribute. If turnover is fine, definitely you'll get good return. This is the risk of this is the risk and return of highly geared company. Here the see this is what is say. The Breakout is how much? Breakout gearing. Is it? Breakout gearing is how much? Breakout gearing is 71%. Is that? Breakout gearing is how much? 71%. Breakout gearing is how much? Gearing is how much? 71%. Whereas Astral is how much? Astral is 35%. Is that? See the more the gearing, the more the financial risk. The more the gearing, the more the lesser the credit ratings. Is right? The more the gearing, definitely it will have implications. If things are going fine, you take loan, nothing will happen. Nothing will happen. But if you have already loan and things are not moving as per our expectations, definitely it will have little bit, definitely panic situation. Okay? Overdraft has so no cash to invest in any more plant and equipment. In the light of this, a dividend policy is not particularly wise. There is a lower turnover, conservative dividends. How much they are saying? Dividends. They are focusing on everything. Dividends is how much? 3.6 times, 1.4 times. See, how much? 3.6, 1.4. 3.6, 1.4 is for Astral. Is it right? 3.6 is for Astral. Sorry. 3.6 is for Astral. 3.6 is for Astral. Dividends. Is it? Dividends. 3.6 for Astral and 1.4 dividend cover 1.4 for Breakout. See that means if you take the things that a hassle decision will probably depend the hassle the company which want to buy make investment probably depends on the attitude of risk. If they want to take, if you want to take more risk, is it right? If hassle want to take, is it right? Hassle wants to take more high risk, is it? If want to take high risk, they will go it for whom? They will go it for the breakout. If they want to take less low risk, is it right? If they want to take low risk, then they will go for a Astral company. Yeah, this is the basic summary about the things how it happens. Are you clear about this? It is for 20 marks. Now you can understand. Is that calculations and subsequently we'll take. See, because you are explaining this, it will take almost 15 minutes. But if you do it in an examination with all the help of the Excel sheets, all those things, it will not take maximum 20 to 25 minutes. Okay, 20 marks you have that concept, is it? 20 marks. The rule says 20 into 1.8 minutes. Is it 20 into 1.8 minutes? This is the for how much you have to take. It comes to how much maximum it will take. How many minutes? It will take 36 minutes. In 36 minutes also, see, take it a margin. You have to complete we have to put a target of how much? 30 minutes plus 6 minutes will be our cushion time. We will have in case of plus or minus margin. Okay, hope things are clear for you. And any doubts, any comment, any things is there, just you mention in the comment section. Just wait. Again I will post another question related to another concept in few days. Okay, and in the end again I will say the same thing. Share it, subscribe it, and like it. Thank you so much. Best of luck.